Good morning, everyone. Thank you for joining us today for our Paycheck Protection Program Flexibility Act webinar. It's been an exciting run, and this is just the latest in a string of events of new and exciting information that we want to pour over for you. And as always, if you have any questions, feel free to submit those, and as time allows, we will address them on the webinar. If we don't have time today, we will be sure to follow up later on and update our frequently asked questions on our website. My name is Mark Heath, and I am Partner and Director of Tax Services here at McConley & Asbury. With me today, as always, is David Blain, Partner and Director of Entrepreneurial Services. Now, just a quick little talk about McConley & Asbury. We are a central Pennsylvania accounting firm with about 100 employees, 8 partners. We have 3 offices. We provide assurance, attest, tax advisory and consulting services across a number of industries: affordable housing, construction, employee benefit plans, family-owned businesses, healthcare, insurance, manufacturing, and nonprofits. If we can help you out in any way, we would love to talk to you about any of these services, not just what we're going to be talking about today. But again, today, the Paycheck Protection Program, the latest events are our focus. We are able to help with the forgiveness applications, questions, anything that you need us on. Feel free to contact us. So today, what we're going to be talking about, all the recent changes that HR 7010, the Flexibility Act of 2020, made to the Paycheck Protection Program. When we first got to read the act, we were all very excited because we just kind of assumed that it was going to answer all of our questions. And once again, as usual, we were disappointed. If you read the sorry.
You think so, Mark? It wasn't clear and concise.
if you read the act itself, it doesn't do anything other than just cause problems, which was very frustrating. And in particular, the biggest one was they changed the payroll percentage, the required payroll percentage, to 60%. Which is good, except for when you read the act, the way it's written, it's a cliff thing. So if you don't hit 60%, you get 0 forgiveness. And we're all kind of like, well, that's not right. And so we waited for the guidance. And I'm getting ahead of myself. We're going to go over all of that. So things they changed: the covered period, we're going from 8 to 24 weeks. It's optional. The percentages of payroll, non-payroll. A cap on compensation, which is just math, because if you go to the 24-week period, there's the extension of time to meet the FTE and salary reduction tests, the repayment terms, and they did throw in there, which was nice, even if you get loan forgiveness, you're going to have enhanced, you're going to be able to continue to defer your Social Security taxes. In addition to this, outside of the PPP program, we're going to talk about the future, what we see might be coming down the road for changes. And outside of the PPP, we're going to be talking about EIDL. We're going to get you an update on that, as well as some relief programs just put in place specifically for Pennsylvania small businesses. And this, I feel like this has never been more true.
Yeah, this is the motto, right? Every webinar, Mark, it seems like we have a little, we have something that kind of like is the motto of the webinar.
Right.
And this is your idea, Mark. This is a good one. I really felt like this is right on.
I mean, it's like I said, it's never been more true. Life is like a box of chocolates. You never know what you're going to get. What I would love to do is get one of those box of chocolates that has the map on it. So it has the little pamphlet in it where you can see what you're getting. So, if, good grief, what if you're allergic to peanut butter? I mean, I guess if you're allergic to peanut butter, you wouldn't even risk it. But help us out here. Maybe if Congress could get this map of the chocolates, that would give them a hint that, hey, we need a little more guidance on this. So enough from me. I'm going to turn it over to Dave. Dave's going to be going over the specific changes in the act.
All right, Mark. Thanks, and great to be with everybody again here, Mark. Mark, how you doing anyways? I mean, everything going pretty well for you?
Yeah, I'm good. I mean, we're still here in the yellow in Lancaster. I know everybody in Dauphin and Cumberland is very excited to be in the green, but we're still here in the yellow, just hanging out. We'll let you know when we get to green.
Okay. You let us know. So as Mark said, lot of things going on here with this act. The first thing I want to make sure that everybody's aware of, Mark and I talked about this, is that we're going to go over some of the changes that have been passed in HR Bill 7010. But the big thing that did not change, and I want to make sure everybody in webinar land understands this, is that what is forgivable in regards to the payroll expenses and the non-payroll expenses, those items have not changed. So when you talk about payroll being gross payroll, being contributions to retirement plans, benefit plans, those items there's nothing has changed in regards to that, and nothing has changed in regards to the non-payroll items such as rent, utilities, transportation costs. Those items have not changed. Primarily, what has changed is going to be time periods and some of the base calculations around how things work. So without further ado, we're going to get started here and talk about the covered period. So the big thing that everybody's talking about right now is this covered period scenario. The initial act talked about 8 weeks. It said that from the date you get your loan funded, you have 8 weeks from that funding period or that 56-day window to use your money on payroll and non-payroll costs. With HR 7010, what they've done is they've decided that, and this is through a lot of lobbying from a lot of organizations and a lot of associations out there, the construction, manufacturing markets that were heavily impacted by this hospitality industries. They said, you know what, using the money within that 8-week period was really difficult for us. It's difficult from the perspective of what if we were being mandated to stay shut down because of some type of state mandate in regards to shutdown rules. It was just too difficult to be able to use the money during that time period. We need a bigger window of time to use that money. So what HR 7010 did is try to put a fix in place for that by saying we're going to triple that time period from 8 weeks to 24 weeks from the date you're funded. Again, that rule doesn't change. It's still from the date you're funded. You got 24 weeks to use the money in that week. And the covered period is defined as 24 weeks following the funding of the loan or December 31, whichever comes first. So you basically have that 24-week period, or if for some reason you apply for the Paycheck Protection Loan at a later time and your funding runs through December 31, you have to that time period to use it. Now, one of the items that is a little odd in regards to the new act that's out there is it talks about this whole thing between pre-June 5th and post-June 5th. So if you are a pre-June 5th borrower, you're not actually required to adopt this 24-week period. You can actually continue to stay within the 8-week period that you receive the money. That might be advantageous for a lot of companies, depending on if you were still in operation during that time. You were able to, you budgeted to use that money within that 8-week period, and you were able to establish your FTE counts and all that kind of great stuff. If you're post-June 5th borrower, if you've now just today been funded, you have to work inside the 24-week covered period. You don't have any option. You can't just say, well, I'm going to do this and stay within the 8-week period. You have to work within the 24-week covered period. So that is one item, Mark, within the whole act. That is a little bit odd if you think about it. This whole pre-June 5th and post-June 5th thing, it's almost like it's like a drawing a line in the sand type of thing.
Yeah, and we were just talking about this before the webinar started. This creates essentially two regimes, kind of the pre-June 5th and the post-June 5th, depending on when you applied for the loan. Now, how many borrowers is this actually going to affect? I'm sure it's, the number is going to be a decent number, but percentage-wise, in terms of percentage of borrowers, I mean, the vast majority, I feel like, would have been before June 5th for borrowers. But even if you got your loan after June 5th, if you got everything set up to do it within 8 weeks, just do it. I mean, all the calculations are averages, so it would still be averaged over, the 24-week time period. But you should be able to use it how you want to use it to make sure you get full forgiveness. Again, as long as you're using it for payroll costs, you apply or you comply with the 60/40 rule, and the other covered costs, you should be fine. So kind of the general thinking is this was a nod to say, hey, we want to make it easier for you to get full forgiveness as long as you use the money for what it was intended for.
Exactly. And the other thing too about this is again, you're going to have to run the numbers. Because majority of people are going to be pre-June 5th, or companies will be pre-June 5th, just because if you look at what was left in the PPP loan program at the end of May, there was about 115 million or $1 billion left in the fund. So 3/4 of all that money is already out the door. So most everybody's pre-June 5th. You're going to have to run the numbers to see what makes the most sense for you, whether you want to be 8 weeks or 24 weeks, based upon some of the things we're going to talk about next.
Yeah, and I would say if you were a pre-June 5th borrower and you've done everything, just within the 8 weeks, just stick with that 8 weeks. As long as your calculations are correct and you're going to get full forgiveness, just forget this ever happened and just stick with your 8-week period.
Right. All right, Larry, I got to go on to the next one. So the next big change outside of this covered period is this payroll and non-payroll change. So if everybody recalls, back at the original CARES Act, when it was passed, it said that you had to spend at a minimum 75% on payroll costs, and you couldn't spend more than 25% on non-payroll costs. And I'm going to reiterate to everybody that what is considered payroll cost and what is considered non-payroll cost, those definitions have not changed of what you can include in your forgivable calculations. Nothing in those items have changed. It's only the percentages have changed. So now what they've said is, because again, a lot of pushback from industry in regards to the ability to spend the 75%, specifically around the whole idea of trying to spend this 75% at a minimum, using this 2.5 multiplier that you had to use within an 8-week period. When you do the math, it doesn't work. So what they tried to say is, we're going to extend to 24 weeks, and also to make it easier for you to use the payroll dollars, we're going to say that you have to use at a minimum 60% for payroll, and the other remaining 40% can be used for non-payroll costs. So again, it goes back to the idea that if you want forgiveness, the forgiveness works in regards to, you have to make sure that you can show 60% that you use for payroll. If you can't show 60% that you use for payroll, then your forgiveness gets reduced proportionally based upon whatever that percentage is that's different. So if only 55% is used for payroll, you lose 5% of the forgiveness, just like the rules that were under the 75-25 rule. Going back to what Mark was saying a little earlier, when the initial changes to this Flexibility Act came out, there wasn't a lot of clear guidance around this 60% rule. It almost established what looked to be like a cliff that said that if you weren't able to use at least 60% towards payroll, nothing was forgivable then, that you had to use 60%. Since then, Treasury Secretary Mnuchin, in front of the Senate Oversight Committee on this matter last week, was very clear in regards to, there is no cliff, that the rules are similar to what the rules were under the 75-25 rule, that we want you to use the 60% towards payroll. If you can't use the 60% towards payroll, and it's some percentage that's less than that, then your forgiveness would be reduced by whatever that percentage difference is. But that's how the act would work. So really, again, it just comes down to, now, instead of 75-25, it's 60-40. I want to reiterate again, because we're getting a lot of questions about, is certain retirement contributions allowable. Again, what is allowable hasn't changed. It's just the 60-40 payroll versus non-payroll split that has changed from the 75-25.
Yeah, this caused the most angst, I think, of anything in here, that you had to use 75% for payroll, and everybody scrambled, made sure they got over the hurdles, checked all the boxes, and then now they come out and just say 60%. It kind of makes me wonder. I mean, who's in charge?
I mean, seriously. I mean, it's like who's in charge of the asylum right now? I mean, it's sort of I like what they did here, Mark. I do like what they did by changing it to 60-40, because the initial math didn't work. I mean, we talked about this on previous webinars, and we've talked about this with numerous clients and people and organizations and individuals have contacted us that, you know, giving a 2.5 multiplier on 2019 monthly payroll cost, and then saying you have to spend 75% of it in 8 weeks. Oh yeah, by the way, you're under shutdown because of state mandate, so it's going to be hard for you to bring those people back. And yeah, we want you to pay them just to be at home. But the reality is, I mean, how much payroll in that 2019 number that you're using to calculate your loan was overtime payroll to employees, maybe some type of small bonus payroll. You know, at the end of the day, it just became, the math just didn't work.
Yeah, and we did hear a lot of instances where employers wanted to use the 75%, use it for payroll, even if the employees aren't working, but they couldn't find them, or the people had found other jobs, or the people were saying, no, I'm not going to take this because I'm getting paid more on unemployment. So don't, you know, give this to me, even though that technically kicks you out of unemployment because you are turning down a job, but that's another issue. And employers were saying, I need to use more than 75% or more than 25% for non-payroll just to keep the lights on, to keep the rent up, so that when this thing ends, there's a place for the employees to come back to. It stinks that I can't pay them all now, but I need to make sure that my building is still here so that when they come back, there's some place to come back to. So they, you know, that's the good news. They listened. Yeah, we joke around about who's in charge, but at the end of the day, because I've never seen anything like this where Congress passes one thing and Treasury just comes out and says, no, 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 that's not what we're going to do, and they just change the rules. So it is, in the end, it is good that they are doing this, but it would just be obviously a lot nicer, particularly for an accountant who just likes hard and fast rules to follow. You know, just if we just had the rules there codified in the law that says what to do, and we don't have to rely on these just rulings, this interim guidance from Treasury.
Yeah, I couldn't agree with you more, Mark. And you know, the other part here is kind of disappointing, or I won't say disappointing, because I think the program in general is a good program. I think what is a little bit disappointing is the fact of a lot of companies took this money and had made plans around that 8-week covered period to spend 75% on the payroll so they can get the forgiveness. Now the rules changed, and they could have done some things differently, and you've been able to operate in a different manner and fashion than what the rules say now. Because now, because that ship has sailed. For a lot of companies, that ship has sailed. You know what I mean?
Yeah, for most of them, the money's already gone, and
exactly.
they can't go back now and pay rent or whatever else to make sure they have a building to come back to.
Yeah, exactly. Okay, all right. So as we move on, compensation gap. So this is another one that is that I think needs a little bit more clarity too, Mark, because really at the end of the day, this has a major impact on those that are you know, filing because they're subcontractors, you know, or they're independent contractors of some sort. But you know, in the original CARES Act, we talked about this $100,000 compensation limit per employee, and we were saying that basically what that does is it says that anybody that makes more than 100,000, you're capped at 100,000, which means over that 8-week period, if you take 8/52 of the 100,000, it's 15,385 for the for that 8-week period. Now what this has done is it said, because if you pick the 24-week period now, obviously now you can take 46,154, which would be 3 times, obviously because the weeks are going up 3 times. That you would be able to include for those that are at that compensation cap of $100,000. Now, the question that needs to be clarified, I think more, Mark, and you tell me what you think, but what about these independent contractors? You know what I mean? Because initially, this was a problem for these independent contractors because they went out there, they used the 2.5 multiplier. It didn't look like, and if they didn't have any expenses, they looked like they were going to have to pay some of this back. Now, all of a sudden, you're going to this 24-week period. Looks to me like they're pretty much free and clear. Should be no issues in regards to loan forgiveness based upon what we're seeing right here. But I mean, what's the chances that we're going to see some type of modification to this for independent contractors?
Yeah, that would make sense because the way things stand right now, it's almost impossible for independent contractors to get full forgiveness. They would just have to give some of the money back. in which case, why'd you give it to them in the first place? But and I also have the same question for owners. So right now with the forgiveness application, if you're an owner, you're capped at 15,385. Now we know for a fact they're going to have to redo the forgiveness application because it doesn't comply with the current guidance. So they're going to have to do a new one. And when they originally released the forgiveness application, that whole 15,385 was a surprise for owners. And so, but now is that going to go up to the 46,154 for owners for, because obviously it's 24 weeks, even if you were pre-June 5th and you were in the 8 weeks. So, this is again, where Dave was saying earlier, you got to run the numbers. So even if you set everything up to be paid all within 8 weeks and you're good, you may want to revisit that and choose the 24-week period to see if you can get to make sure that you're getting the best possible answer for all of this. And again, we're looking for when the new forgiveness application comes out, hopefully all of that will be addressed on there in the instructions.
Exactly. I mean, and again, that's the whole key here. One of the reasons why we delayed doing a webinar initially is because we want to see what this loan forgiveness application is going to be, because the Treasury, SBA all came out and said when this act was signed on June 5th, that they were going to expeditiously come up with a new loan application to get that out to everybody. And here we are on the 16th of June, and we still don't see what this loan application actually looks like. And I'm sure that not only those that want forgiveness are curious, but the banks. Think about the banks. I mean, what's going through their heads right now in regards to these loan applications and what to expect in regards to the 8 weeks or 24 weeks and how that's going to be picked. But we'll have to see. We'll have to just wait and see what the loan application says, Mark. All right. So on to this extension of time to cure this FTE and salary reduction. So, under the initial act, and when you looked at the initial application, we talked about this whole scenario of you had until June 30th to restore all your FTEs or salary levels, or you would face some type of potential reduction, either based upon the way the calculations worked in the application. What the new act has said, what HR 710 has done, is it said, you know what? Because we're going to give you this extension of time for, if you choose, to 24 weeks. We are also going to give you a deadline of now December 31st, of which to restore your FTEs and salary levels instead of June 30th. Now, wow, that sounds great and all, Mark. So, Mark, going back to this extension of time thing, wow, it sounds great that you can extend this to December 31st. Here's where you got to really start to think through, do I want to use this 24-week time period, or do I want to use the 8-week time period? Because for lots of, I mean, how many organizations have you, Mark, have you heard from where they've come back and said to you, hey, can I lay people off after my 8-week time period, because I'm going to be in a situation where I'm not going to be at full 100% workload, and I'm still going to have a situation, and I have this payroll money and I've been using it and I've been paying my people, but once this runs out and it's gone, I'm not going to be able to keep all these people on. I'm going to have to lay some people off. So this is where you got to run the numbers and figure out what makes the most sense, whether it's the 8 weeks or the 24 weeks, because you don't want to be in a situation, Mark, where, hey, at December 31st, I have to have my FTE counts restored back to pre-coronavirus levels of February 15th, because you might not be there.
Right. Yeah. There's this caused so many problems because it's very ambiguous. It just says the deadline to restore FTEs and salary levels has been extended to 12/31. So, but what does that mean? So if I restore FTEs and salary levels by June 30th, do I get full forgiveness even if between June 30th and 12/31 I have to lay people off? I would make the argument, well, I restored them.
Exactly.
I restored them prior to 12/31. That is an honest statement. So in my mind, I feel like that would suffice. But if their intention is to get everyone back to full employment by 12/31, then, well, one, how do you even know? I mean, you're going to be sitting here waiting 6 months to figure out whether or not you get full forgiveness. That doesn't make any sense. So again, I feel like this is something that's going to have to be addressed on the forgiveness application.
Yeah, because no one knows what's going to happen in the back half of the year. The second half of the year, no one knows for sure what's going to happen. I mean,
Right.
there's all this discussion about resurgence of coronavirus. You got Governor Cuomo in New York talking about shutting areas down again
Yeah.
if there's a spike. I mean, these are all things that people are going to have to take into account with their organizations. That's why running the numbers and figuring out what makes the most sense from this 8-week or 24-week in regards to this very specific item of FTE and salary reductions is going to be key. So the other thing too that was passed as part of this FTE and salary reduction thing is this whole idea that they are going to provide some type of relief and a little bit more guidance in regards to whether you are able to rehire individuals for unfilled positions, or there is any inability to do so because of continued shutdowns. And that's what they laid out here. Is we said, businesses that remain partially or fully closed will gain some relief with this FTE restoration of 1231. Some of that relief is, as long as it's in good faith in that you have tried to restore these heads, that if there is an inability to rehire individuals who were employees of the borrower at 215.20. So in other words, these employees may not want to come back because they feel like the work environment's unsafe, or something of that nature. You did extend an opportunity for them to come back, and they just refused to come back because of issues in regards to safety or some type of issue with the organization. Inability to hire similarly qualified employees for unfulfilled positions. So in other words, you are trying to hire, you just can't hire the position. So they will, as long as you can document these items, they will give you some relief to your FTE count. And then the final thing is that if there is an inability to return to the same level of business activity as the business was operating before 215, due to compliance issues from SHHS, or Secretary of Health and Human Services, CDC, OSHA, that would cause some type of issue of being able to bring people back and to restore those headcount items. Again, in all three of these scenarios, you're going to have to be able to clearly document this for your loan officer and for the bank that you were not able to restore these FTEs because of these manners. So, I mean, I will say that this is one item that should provide some relief to anybody who's taken the 24-week period and is trying to restore headcount FTE at the end of the quarter.
So there's two words in here that I love. The first one is some. Second one is inability. So they are going. You will be able to gain some relief. What does that mean? Is that all of it? Is it 1%? I don't know. I'd love to know the answer to that question. What does inability mean? So inability to hire similarly qualified employees for unfilled positions on or before 12/31. Is I can't pay them? Is that an inability?
You make a great point, Mark.
and then at the end, when we first read this, it's the inability to return the same level of business activity. It's like, finally, okay, they recognized that if your business just is cut in half, you're not going to be able to to sustain the FTE, headcount, salary levels, etc. But then they go through this like painstaking detail of it only your business activity, inability to return to the same level of business activity only if you weren't able to comply with all of these different guidelines, or it made it more expensive. And this, I mean, good grief, why didn't they just say this is for the restaurant industry? Because dining inside, if you can only be 50% capacity, then by definition, your level of business activity is probably going to be cut by 50%. So I get why they put this in there, but it seems like in the beginning, everything was so not restaurant or otherwise entertainment service activity friendly, to now it's like specifically geared towards them. But then everyone else is now like, well, what does this mean? What if the inability is because I don't have any money, does that count as an inability? I don't know.
I would be, I'm waiting for the FAQ to come out on this one. You know,
Right.
SBA question number 53, definition of inability. You're 100% right though, Mark. It's you know, it's well, it reads great, and you know, the intentions are good. It's the vague language that's sometimes used that makes it very difficult to figure out. Like, well, how do I define inability? Just like you said, what does that mean? So I would be surprised we don't see another set of guidance that comes out that's more specific around these matters right here, specifically on how you document this and you give it to the in what you provide to your loan officer. All right, so let's move on to the repayment terms. So repayment terms now. Again, this is where it gets a little interesting, Mark, because remember in the original CARES Act, they said, hey, we're going to make this for anything that's not forgiven, it's going to be a 2-year loan. It's going to be at 1% interest. First 6 months will be deferred, and then you'll pay the remaining 18 months of whatever's not forgiven over that 18-month period. And I remember reading in the original act that they said that they felt like that was appropriate. The Treasury Secretary felt like that was appropriate because the intent of the act was to provide money to organizations to put back into the economy through payroll, and that there shouldn't be a lot of money that needs to be repaid. So having a short window of time to repay it made total sense. Now all of a sudden they come back and say, well, wait a minute. We're going to change the repayment terms of 5 years, but Mark, we're only going to let that for those that are post June 5th borrowers, that you have 5 years to repay your loan proceeds that are not forgiven. If you're a pre-June 5th borrower, you will have to still follow the guidance of the original act. So I didn't even understand why you even put that in there. I think that what that is it's a clarification that they're going to have to make, or something clerical they're going to have to change in the act to make it more consistent. But right now, when you read the act the way it is, it basically says that if you're a pre-June 5th, you still got to stay under this 2-year window. Post June 5th, if you got your money, you got 5 years.
Yeah, and again, this goes back to the pre-June 5th and the post-June 5th regimes. One thing that actually I just thought of right now, because it does make a huge difference on this part of it, is which I'm honestly not sure of. I want to go back and read the act. When it said the June 5th date, and Dave, maybe you know this, is it if I applied for the loan on June 4th but was funded on June 10th, which am I?
That's a really good question. And what I've read is it talks about, it goes back to when you were funded.
Okay, because that's what the covered period is based on.
Yeah.
But all the language just says post June 5th borrowers. But if I applied, yeah. So, all right. But
this is interesting. The whole repayment term, this is interesting too. I think it's just going to cause more confusion again. With especially the argument of, just like you said, Mark. Well, I got my loan number on the 4th. Does that mean I'm pre-June 5th, or because I didn't get funded till the 10th? I mean, am I post-June 5th? What am I? I couldn't spend the money until June 10th. So, but am I post or pre?
Right. I mean, I guess hopefully if you were pre-June 5th and you couldn't spend it within the 8 weeks, that you will be able to spend it within the 24 and get full forgiveness. So this doesn't matter. And if you're post June 5th, again, you just have your 24-week period. Hopefully you can just spend it all and it's a non-event. Right.
All right. Let's move on here. So one item, Mark, that I do kind of really like about HR 7010 is the idea that now they've said that even if you get loan forgiveness, we're going to still give you the rest of the year to defer your payroll taxes, and then you can follow the 50% paid in 2021 and 50% paid in 2022. I think that's a good thing, quite honestly. I just think that at the end of the day, whether you had a loan or not, you as the employer are still responsible for payroll taxes, right? So why not put everybody on the same playing field, make it level, give everybody that opportunity to defer those taxes into 2021 and 22. I think it's just, from a clerical perspective, just makes it a lot cleaner than the original act that said, well, we'll let you defer payroll taxes up to the time of loan forgiveness, and then after that, you have to start paying them. I just think that, what if you're in the middle of a period You know, how's that affect your 941s? It's just, I think it just gets confusing.
Yeah, it created an administrative nightmare having to cut off in the middle of a pay period, you know, whatever. So, but yeah, but again, this was very helpful in that it obviously allows all these employers to just hold on to that cash until later on now. But there are some other problems, which we had from the beginning. You know, what if you defer your Social Security taxes and then you go out of business?
Yeah, very good point. Obviously, the federal government's not going to get the Social Security taxes, and then what kind of you know, and what is the you know, because if you think about Social Security taxes, Medicare taxes, you're just the business is just a conduit between, you know what I mean? So it's at the end of the day, you know, how is that going to be handled, and who's ultimately liable at the end of the day for those taxes?
Yep.
All right, moving on. So that was the big changes from the Paycheck Protection Program Flexibility Act. Those 5 or 6 significant changes, we'll call them, but you know, they were the big changes. A couple other things though that have come out since this act was signed on June 5th. Last week there was a congressional hearing that from what had been listened to in that congressional hearing, actually both parties, the Republicans and Democrats, got along very well, and we're all on the same page in regards to this Paycheck Protection Program and how this thing should operate. So if there's any hope in the country, that might be one of them, is that both parties seem to be on the same page with some of the things in this Senate hearing. But a couple things that were talked about in the Senate hearing were a simplification of the application process. Both Senators Cory Booker and Mitt Romney were pretty much on the same page in regards to directing the Treasury Secretary to simplifying the application process. The other thing too was the possible extension of the June 30th deadline for applying for the PPP. Right now it ends on June 30th. There's a talk about extending that for at least 30 or 60 more days. So because there is additional funds still left in the program of up to $100 billion that still need to be expended. The other thing too was there was discussion about a possible PPP2 program, you know, to add additional stimulus into the economy. Secretary Mnuchin mentioned the fact that he felt that the economy, he wanted to see this $3 trillion that's in the economy right now, see what the effect would take. But in the second half of the year, there might be the additional need to put additional stimulus into the economy. So well, that's kind of a wait and see. We put don't hold your breath on this because, I mean, $3 trillion, Mark, is a big number. I mean, when you write that out, I mean, it's a pretty big number. So to think that you're going to put more stimulus in the economy, I think that that's going to be a tough one, but we'll see where that goes. Go ahead, Mark.
Yeah, I'm when you look at the numbers in like Texas and Arizona, if we go back into shutdown mode in any large scale across the country, I think they're going to have to.
Yeah, exactly. So that's why I think the second half of the year is going to be really interesting to see how this all plays out.
Mm-hmm.
The other thing too they talked about in this Senate hearing was additional payroll and other job creation tax credits. What they are, no one knows for sure. But that's, you know, as we say here, yet to be determined. But that was discussed in the Senate hearing, and I believe that this Treasury Secretary is looking at that in regards to how there might be some other job or incentive tax credits that might be able to be put out there to try to create hirings and to stimulate the economy a little bit from that perspective.
Yeah, and the one easy thing they could do there, which is gaining a lot of traction, is just saying if you took a PPP loan, then you can also take the employer retention tax credits. Because right now you can't do both. If they would just, you know, strike that line in the thing that says you can do both, that would be a real easy fix for all of this. The other thing that we haven't heard anything recently in the past couple of weeks anyway on is, if you recall, so when you get a PPP loan, the funds are not taxable. However, IRS, in my opinion, correctly came out and said, that's great. The law says if you have non-taxable income, the expenses that are paid with that income, those expenses are non-deductible. So that puts you back in the same position as if the income were taxable. So that was the IRS, to me, saying to Congress, if that was your intent, fix it. We don't make law, you make law, so fix it. There's a bill sitting out there, a bipartisan bill that would, and it's specifically just for this, to make the expenses deductible. And maybe, they just haven't gotten around to it yet, and they have every intention of passing it. They just have bigger and better things to worry about. So that is another thing that we could see coming down the road, that all these expenses would be deductible, which would be very helpful.
Exactly. All right. Let's talk about EIDL. So we're going to get away from the Paycheck Protection Program. We're going to talk about the Economic Injury Disaster Loan Program very quickly. So as of this morning, the SBA came out and said that they are now accepting applications, again, for the EIDL program. Everybody keep in mind that they cut the program off on April 15th because it ran out of funding. When the funding was reauthorized, they came back and said that they were really only focused on applications from agricultural interests because they wanted to get enough money and funding into the agricultural sector to keep that moving. Now what they've came back with this morning is they said they're accepting all applications, moving forward with processing all applications, and are basically telling organizations, please apply. We're going to process your application as quickly as possible. So a couple things about the EIDL program is, again, one thing is, it was originally a $2 million max. They reduced that to 150,000. So wow, that has significantly reduced. I will tell you this. They are working pretty quickly on trying to process applications as quickly as possible. A number of my clients have been funded with EIDL funding here very recently. They applied either late March or early April. They are now going through the process of getting their loan docs, finalizing their lending, and that seems to be moving through. And most everybody is getting $150,000. So I think the SBA is really trying to work very, very diligently to try to process these applications as quickly as possible. Keep in mind, it's a 30-year term loan, 3.75% interest, fixed rate. First year of the loan is deferred. But again, we just saw guidance that came out this morning from the SBA that said, please get your, please apply. We're taking all applications now, not just agricultural applications. So they're working heavy on the side of trying to get money out the door to businesses at this point. All right. I'm going to turn it over to Mark. Mark, why don't you talk a little bit about these statewide small business assistance programs that are out there that the governor and leaders of the legislature here in Pennsylvania have come up with?
Yeah, this is, we just want to make sure everyone was aware of this. It is a more narrow program than the federal ones. It's just for Pennsylvania companies, and it was announced last week. The state was essentially pushing $225 million to the DCED, the Department of Economic Development, to have CDFIs. CDFIs are Community Development Financial Institutions, for them to provide grants to small businesses. Again, this is a grant, which means it doesn't need to be paid back. Presumably, as long as you comply with the rules, you're perfectly fine. It would be taxable income, most likely. Maybe not in Pennsylvania, they haven't specified, but at least federally, it would most likely be taxable. It's just to cover operating expenses. It is capped at $50,000. There's a little asterisk beside the rules that says, in extreme circumstances, you might be able to go more. It's for small businesses, which is defined as having 25 or fewer employees. There's an asterisk there too that says in extreme circumstances they can make an exception. And there's 3 different programs, all going through the CDFI network. There are community development financial institutions all throughout the state. If you go to the DCED's website, they have all of the rules and guidelines there. We just want to make sure everybody was aware of this. It's not going to apply to a ton of companies. Well, it'll apply to a lot of companies, but it is more narrow in that, again, it's only $50,000 and it's for companies with 25 or fewer employees. But we wanted to make sure that we put it out there so everybody was aware.
Okay.
So, and actually, yeah, if you go to the next slide, we have the specific requirements. It's funny, they threw in there that you paid your income taxes if you were required to. So nonprofits aren't required to, so you're still eligible. But basically, they're going to go back and look and say, well, if you haven't paid the income taxes that you're supposed to pay last year, you're not going to be eligible for this loan. So you can't start up a company now and apply. Had to be in operation on February 15th. Again, 25 or fewer employees, capped at $50,000. And there's a link there at the bottom that will take you to the DCED's website with the guidelines. And then there's a link on that page to the specific PDF that you can download that has every detail you could ever possibly imagine on the program.
Sounds good. So Mark, I think we're at the end. Why don't we spend a little bit of time going through some of the questions that we have that have come up, and maybe we can take some time and answer some of the questions. My thought, Mark, would be is we can also do the same thing we've done in past webinars, where we'll take the questions, anything that's not answered, we'll do an FAQ, get those questions and answers out to everybody on our website, and have those posted as quickly as we can. So why don't we do that? Why don't we take a look at some of the questions that we have coming in here at this point.
All right. So the first one we got was somebody who's questioning, they heard somewhere where W-2 owners, the owner-employee designation, if you recall, that if they own less than 20%, that they should go on Schedule A with all the other employees. I've seen nothing that says that. The application for the forgiveness application is pretty clear. It just says owners. If you're an owner, you don't go on the schedule. You only go on line 9. There might be some confusion there, because if you go to the back of the forgiveness application, the optional demographic information asks for owners owning more, how many owners you have who own more than 20%. And actually, it doesn't even use the word owner, it says principal. So I don't know if somebody's thinking that their definition of owner is only more than 20%. We don't see anything like that in the forgiveness application, but I could see some confusion because in the demographic information, it defines principal as owning more than 20%. But we're not seeing, you know, if you're an owner, the way we read the application, if you're an owner, you go on line 9, you do not go on Schedule A.
Right. Next question here talks about, I'm sure, do we have 24 weeks over which to spend the loan on payroll? Again, you can choose the 24 weeks, or if you were funded pre-June 5th, you could choose the 8 weeks. I would suggest that you calculate what makes the most sense for you, and use that calculation.
Once we have used all of our PPP funding, can we lay staff off without a penalty or having to pay back any of the funds? That is a loaded question. So if you used all your PPP funding and you used 60% for payroll, at least 60% for payroll, and your FTE test over the average of the period, if you meet that test, and if you didn't reduce the salaries during the period by more than 25%, then yes, you should be fine. You don't need to restore anything after the end of the covered period. You don't have to, well, there'd be nothing to restore because during the covered period, you didn't lay anybody off or reduce salaries. And there's nothing in there that says after the end of your covered period, if you've met all the requirements, you can't just lay everybody off if you can't pay them. So you should be fine as long as you meet all the requirements during the covered period.
Exactly. How about this one, Mark? This is a good question. We have used all of our PPP loan in 10 weeks. Do we have to wait to the end of the 24 weeks to file, or can we do it after the 10 weeks? You know, that's an interesting concept too, Mark, because how do you handle the FTE calculation, or the FTE safe harbor? You know what I mean? Because I mean, you either got to pick obviously you're not picking the 8-week time period, right? And if you were using the 8-week time period, you'd have the June 30th. If you're using the 10-week time period, you're obviously using the 24-week, which means that you have the FTE safe harbor at the end of at the end of December. Interesting question, which I think might need more clarification from the SBA.
I think you have. Well, again, I think this will be answered by the loan or the application for forgiveness, I think you have to wait until the end of 24 weeks to do your math, right? Because you'd have to, your FTE count, your salary level has to stay over the whole period.
Yeah, I mean, how about the situation where you spent all the money in 10 weeks?
Right.
You spent all the money, you stayed within, you know, you in that 10 weeks, you stayed within the 60/40 rule, the payroll, non-payroll, all the money is used. Yeah, I think there's gonna have to be more guidance on that in regards to how you handle that. Because again, this is where it's gonna be a big problem now, Mark, in the fact that you've got a lot of companies out there that are going to look at this and say, well, you know, this isn't a bad deal for me because I wasn't able to use all my money the way I wanted to use it. And this will give me the ability, the flexibility to spread it out over that 24 weeks now. But the problem is going to be is this whole FTE restoration and salary restoration matter. That's going to put a real wrench into the calculation.
Yeah, and that goes back to the inability thing. If your inability is because you don't have any money, is that okay?
Yeah.
To me, that's an inability.
Right.
Unless you have a bunch of employees who want to work for free.
Right. The next question is about it. If you elect the 8 weeks, are you still able to use the 630 safe harbor cure? I would say yes. I mean, because you're saying that I'm working under the old rules of the 8 weeks. I would assume that you would, you know, that 8 weeks. If that 8 weeks ends before June 30th, which it certainly should, right? You should be able to work under the 630 safe harbor cure.
Yeah, and I think again it comes down to what's their definition of buy. You know, you have the new law, you have until 12/31 to restore. So if you restore it by June 30th, have you met that requirement? Even though after June 30th, then by December 31 you haven't. As long as you did it at some point in time, have you met it? I think so, but we don't know.
Yeah. Another really good question here. Can you choose how many weeks you want to use to apply for forgiveness? You know, again, I mean, that's a really good question because I mean, the initial act, it was pretty clear. It was 8 weeks. Now you have up to 24 weeks. You can use a 24-week period. You know, if you've used all your money, I mean, are you going to wait 24 weeks? Or that's a great question. I'm not sure we have an answer to and might need more clarity.
And again, all the calculations in the forgiveness application currently use 8 weeks, and so you have to look at the entire 8-week period. Are those calculations now going to mandate over 24 weeks if you choose the 24-week period, or is it going to say you can choose any time frame, you know, between 8 and 24 weeks? I don't know. We hired 2 new employees while in our PPP period. Do we need to be cautious about the 25% reduction with them? They started out working 20 hours per week, but are now down to around 10. We do not need them for FTEs. Can I pay them for their actual hours worked, or should I be paying them for closer to the 20 hours? So if they're hourly employees, as long as their hourly rate didn't go down, it doesn't matter whether it's 20 hours or 10 hours. As long as the rate per hour didn't go down, you're fine. But again, I would just caution on the FTE test, because that's where you could get dinged. But if you're saying you don't need them for the FTE test, then no, you should be fine as long as the hourly rate doesn't go down. But again, no, I mean, I guess if they're hired during the period, you're fine. You can pay them whatever you want because you have no measure. You have nothing to measure them against from before the period. So you should be fine either way. Yeah.
Yes, yeah, I would agree with that. I would agree. All right, please confirm if F Corp owner employees can include health premiums and retirement contributions.
So you can up until the $100,000 mark. Originally, again, going back to what seems like about 8 years ago, the way everything read, you could go above the $100,000 for any and all employees, to the extent that the excess over $100,000 constituted health insurance and retirement contributions, non-cash compensation. But then once the forgiveness application came out, again, on the first certification point on page 4, the 4th bullet point under there says the amount that I'm applying for forgiveness for does not include any any amounts over $100,000 for employees or for owner employees. So for S corporation owner employees, you can get up to the $100,000 and that's it. You cannot go above the $100,000 the way the forgiveness application currently reads.
Right. Can we use the old 8-week period and the new 60/40 rule? Otherwise, mix and match the new and old rules. I'm pretty sure what you're going to see is with the new application that comes out, that it's going to be, everything's going to be changed to 60/40, even if it's in an 8-week period, because the whole intent of the change was to give everybody more flexibility on the use of the money. So I'm pretty sure we're going to see that as a change in the application.
Yeah, and that's my understanding is they, because the original CARES Act said nothing about a certain percentage to go to payroll. It was the Treasury that came out and said you have to use 75%.
Yeah.
So now that they've signed that into law that it's 60, I don't think Treasury can deviate from that.
Do you think the 24-week period gives borrowers additional ability to push more of the money to payroll, therefore maximizing forgiveness, basically stretching the 2.5 times multiplier out over a longer period of time? I mean, that goes back to what we were talking about throughout this, and that is the 24-week period does allow you to will allow you, in theory, to expand out your payroll over that longer period of time to be able to use it for payroll, plus the 60/40s, the new 60/40 rule will give you a little bit more flexibility too. But again, I do go back to telling everybody that you got to, based upon when you were funded and how you've already used the money, you're going to have to run the numbers to see what makes the most sense for you, because you also don't want to get yourself in a bind with this 24-week period and your FTE counts and your salary reduction issues. So you want to make sure that you run the numbers and make sure that you use the week period that makes the most sense for you.
If an employee's hours are reduced 25% and they can collect partial unemployment, do they still get the full $600 stipend? I'm going to preface this with, I am not an unemployment compensation expert, and I don't think Dave is either. But my understanding of the $600 stipend is that it doesn't matter whether you're on partial or full unemployment. That if you get it, that if you're eligible for unemployment, you're getting the $600. That's my understanding.
Yeah, that's my understanding too, Mark. But again, as you said, I'm not a unemployment compensation specialist, so I don't know for sure.
Now with the 24 weeks, do you recommend that we use 100% of payroll costs to cover the loan, even though there are non-payroll costs in the time period? This is a two-part question, it looks like. Yeah, nothing wrong with that. I mean, it makes it simple. As long as you don't go over, as long as you comply with all the other rules, sure. I mean, that makes it kind of simple. Also, can you finalize the loan application forgiveness sooner than the 24-week if you can substantiate payroll costs? Again, that's going to be on the forgiveness application to basically how they're doing their math for their tests to make sure that you qualify. If you have to use 24 as your denominator for a lot of the calculations, then you have to wait. If you don't, then you don't.
Yeah, and the other thing too to keep in mind here is the whole goal of this program is to keep people employed, and therefore that's why they have these FTE counts, and that's where it's going to get really tricky. I mean, in regards to that 24-week period, and giving people the ability to cut it off before the end of the 24-week period, because I think what the government wants is you're going to show that you've maintained the headcount through 24 weeks. And that's, again, going back to why it's important to run the numbers as to what's better for you, the 8-week period, a 24-week period.
Yep. When is the loan forgiveness application due by? So there is no date that it says it's due by, and it's never due. I mean, you don't have to even apply for forgiveness if you don't want to. But the banks are required to act within 60 days of you applying. So I would just say as soon as the end of the covered period is over, you would want to get that in so that they can get it processed and you know the answer. But there is no due date. You just have to give them at least 60 days from the end of your covered period to when you would have to start repaying the loan.
All right. If we stay with the 8-week period, can we elect to use 630? I think we talked about that I would say that if you're going to use the 8-week period, I'm sure that's going to get clarified on the new loan application, but I would assume that the 630 FTE count would make the most sense, that they would keep that in there. Did the FTE date change from 630 to 12/31, or is it an option? Does it matter if you choose the 8-week or 24-week 40 FTE? The calculation is an issue for us. Again, it goes back to, you got to run the numbers to see what makes the most sense for you, and use whether the 8-week period is better for you or the 24-week period. Because they do give you the option to use the if you're funded pre-June 5th, they give you the option to use the 8-week period, which I would assume when the new loan application comes back, it's going to allow you to have the FTE count through 6/30. But again, some of that still needs to be clarified with the new loan application when it comes out.
Yeah, my understanding is it did change the date from June 30th to 12/31. The only question is, again, for like the 8th time, if you meet it by June 30th, are you done? Can you just stop there because you've met it prior to 12/31?
Right.
Or is it, we're going to look at this on 12/31 to see what it is? I cannot imagine that's the answer, because you would never be able to apply for loan forgiveness prior to 12/31. So that doesn't really make sense.
Interesting comment here, Mark. I read that there's possibility that they will provide full forgiveness for all loans under 100,000 without filling the full forgiveness application. Have you heard anything like that? I got to be honest with you, haven't heard anything like that. And I read articles on this every day from different editors and editorials out there, and I have not heard anything like that, Mark.
Correct. Yeah, I've heard nothing like that.
Yeah. To clarify, the FTE relief for not being able to rehire employees doesn't apply to businesses who have remained open because they are essential.
No, I think it applies to everybody.
To everybody, yeah. If you got a loan, it applies to everybody.
Yeah, and I guess maybe the question is, we were able to stay open because we're essential, then we would by definition just meet it. Yeah, then you just meet the test and you don't have a problem. But it applies equally to all businesses as far as I know.
Well, Mark, we're at 11 o'clock. Do you want to continue on and go through some of these remaining questions, or what do you think, Mark?
Let me just, we'll just take a minute here. I'm seeing the remaining questions we have. I think all of them we've covered.
Yeah,
but again,
I was gonna say.
Yeah, we'll be covering them in the FAQs. A lot of them are simply, we just don't know yet. We're going to have to wait to see what the loan forgiveness application looks like. So, okay. With that said, thank you again, everyone, for joining us. We do not have the next webinar scheduled, but keep an eye out. We will be scheduling them as additional guidance comes out, and as soon as the loan forgiveness application comes out, assuming there are changes on there that need to be discussed, we will be doing a webinar to keep everyone updated. Do not hesitate to contact us if you have any questions, or if there's anything we can help you out with, whether it's PPP loans, forgiveness, or anything else, accounting, tax, assurance, consulting related. We would love to help you out. So thank you all for joining us, and we'll see you next time.
All right, thank you.